All right, good people. This is the Friday vertical spreads. We are about to get started here, so let's get started. Oh, didn't work. There we go. Awesome. All right, I am going to be sharing my screen today, and we are going to be talking about verticals. And let's do that. Share that. All right, what can you all guys see? Do you see my simulated trading on Thinkorswim?
Yep, that's it.
All right, Thinkorswim. All right. Monitor. We're going to delete that, and let's first do a level set on the room. So this class is week number 4 of the IWT series, where we talk about options. Last week we talked about options 101, where we introduced calls and puts, simple calls and puts. Essentially, when you buy a call on an option, you're saying that you expect the price of the underlying to go up. So meaning from $10 to $11, and so on and so forth. There's two things that should be going up. I should add two things that should be going up. There is the price of the underlying. I'm going to take one, for instance, here, like what's been going up today. Let's pick a crazy stock that's been going up today. Guys, don't laugh, man. Don't laugh, man. Nobody laugh. AMC came down. Oh man, who was in AMC? Beyond. All right. Beyond. I don't have Beyond on my list. How's that? Beyond. Okay, it went up a little bit. It's pulling back, but yeah, this is good enough, right? It's pulling back a little bit, but it looks like it has been on an uptrend. If I look at the 6 months, 1 day, yeah, that's right. It's just been going up, but a little bit of a pullback. So when you buy a call, you're expecting price started off at say 110, and you just it's just going up, and you're going to take advantage and reap that benefit. When you're buying a put, it's the same thing as shorting. Only this time you're using options, right? When you buy a put, let's say Beyond right now is trading at 146 is the strike price, is the current price, and the puts are going at we don't want to do 0 DTE. We always want to buy 60 to 90 days out when you're going long on anything. So 84 is maybe on the higher side. Let's pick July 16, and we are at 146 right now, right? So the closest strike price at the money right now is 145, and if you're going long, then you'd be spending about $12.10. So we want two things to go to work in your favor. When you're buying a put, you are expecting that the price of the underlying, in this case Beyond, is going to go from 145 down to something. It's just going down, and as it goes down, this premium increases. The $12.20 increases. All right, so that's the basic premise. But what's a vertical? That's a one leg, by the way, right? So there's just one leg involved. You either bought one call or you bought one put. That's considered a one leg play. When we go into verticals, it's got a minimum of 2 legs. They can be both calls, so they can be both puts. But you've got at least 2 of them, and because there are 2 of them, you are buying one and selling one. Let's first talk about the one that a lot of people know, which is the credit spreads. The credit spreads. So credit spreads, you're buying. All right, you're buying a long call and you're selling short call. Right? This is a CCS, call credit spread. That's how it's abbreviated in the trading world. When you hear somebody say a CCS, they are referring to a call credit spread. And assuming that the price of the underlying is at say 146 and I want to sell call credit spread on this underlying, then I'd be looking to maybe sell something up here, right? And my thesis is that price is going to remain below whatever price point that I pick. And that is considered the short leg. So let's say, let me edit that, make that 160 even. And I'm going to call that my short leg. Short leg right there. And I'm just going to put a label over here on the left. Let's save that as default. Right? That's my short leg. So when I sell this leg, I don't want price to go up, because if it goes up, then I'm on all of a sudden I'm going to be in the money and I'm going to be out quite a bit. So what I do is I buy some premium, some insurance, and let's say I buy insurance worth $5, in a $5 spread, then I'm just going to buy a spread here, a long call for 165, right? Let me go ahead and edit that, make that 165. And today I'll be going pretty fast, so stop me if you need to. And by the way, Saya is helping me, so she will also be looking at the chat because I can't see the chat right now. So Saya, just let me know if I need to stop and work on a question.
Okay.
Thank you. Long leg. Okay. So hopefully you can all see my chart. Let me get some clutter out of the way. You're looking at beyond. My short leg is that one at 160. My long leg is at 165. So the premise here is that your short leg is closer to the current price relationally. You don't want it very close. In fact, you want it as far away as possible. But in relation to the long leg, it is the one that is near the current price. And your thesis is that as price fluctuates up and down, you don't want price to go into your spread. When you hear that people say that my short leg was breached, it means that price penetrated that spread, that 160, 165, and is now somewhere in the middle. When you hear somebody say that price just went through my spread, it means that price rose, went above 160, went above 165, and is now sitting above 165. At that time, you're looking at maximum loss, right? Maximum loss. And we'll go through some profit loss scenarios to see how it works. Okay. That's the call credit spread. Let me go ahead and label that. I'm just going to label that as CCS. So just remember these acronyms as we call them out. That's the CCS. Let's talk about a PCS. A PCS is guess what? It's a put credit spread, right? It's a bearish strategy. It's bearish because you're expecting price to increase and is not going to breach your short leg. So your short leg, given that we know that the short leg needs to be the one closer to the current price, then we're going to choose a point in the put credit spread where the short leg is not going to be breached. So looking at this daily chart, I can see that Beyond has not moved below 110 in the last few days, right? It started off at 107, gap tapped to about 113 and has kept going up. So maybe just for this example, let's choose a 110 as a good point. Gonna go and do my price level here and edit properties, make that my short leg. Okay, and the price point here is 110. Everybody with me so far? You with me so far? Now, if I am doing a 5-point spread, it means that I'm going to be long the 105 strike. Right? Why the 105? Because it is further away from the current price, and that is my insurance leg. Well, we're going to explain what we mean by insurance. These are terms, by the way, that you will have heard of when you read the curriculum. So 105 is my insurance leg. I'm going to label that for you guys. Long leg. Now, trust me, when you do these, when you do a few of these, you will get these names like the back of your hand. You won't, I'm not even reading anywhere. I just know them, and you will get there. You will get there in one of two ways. Either you're going to lose a lot of money, or you're going to make a lot of money, right? And either way, you need to know when you're losing money or not losing money. So let's talk about that put credit spread here. Let me label it for you guys. How are we doing, Sire? Any questions so far?
No, someone just said if you can do Shopify next.
Okay. All right. So we're just talking about the concept right now, right? We're not doing charts necessarily. We're just doing the concept. We will look at Shopify. So this would be my put credit spread. PCS is what we agree here that is how it is abbreviated in the industry. If you say PCS, everybody is going to understand what that means. Now, the thesis here on a put credit spread is that I am shorting the 110 strike and I'm longing the 105 strike, with my thesis being that price is not going to fall so much as such that it falls and touches the 110, right? Touches the 110 and goes, if it keeps falling and goes below 105, then at that point I will have achieved maximum loss. What's this maximum loss thing that I'm talking about? Well, first and foremost, a vertical is a defined risk strategy. It's defined because at the time that you go in, you know what your maximum loss is and what your maximum profit is. Okay, you know what your maximum loss is and your maximum profit is. It's a good feeling to know what that could potentially be. Well, how do you know what your maximum loss is? The maximum loss, I'll say this one a little slowly, it is the width of the spread. And what is the width of the spread? Anybody take a guess? Where's my chat? What's the width of the spread? The difference in premiums? No. Difference in strikes? Yes. 5 is correct. All right, you're getting it. You're getting it. So the width of my spread is the difference in the strike prices that I chose as the basis for this contract. So this is a 160, 165, and the difference between that is 5 points. And so this is considered a 5-point wide spread. You might hear some people referring to a 10-point wide spread. They are saying that they chose the difference in these two strikes to be 10 points. Why would they do that? We'll go into that a little bit, but for now, let's stick with a 5-point spread. So the maximum profit that you can get is the difference in the width or the width of the spread, which in this case is $5. And then if you remember, you've heard me talk about the multiplier, which is 100. So the width of my spread is $500, right? It's 5 times 100. And then there's a premium that I'm going to receive. I'm going to receive a premium. How much is that premium? It's usually, let's find out what the 160, 165 can give us in premium right now. So it's actually a good thing that the market is open so we can check some of these things in real life. Incidentally, I am using Thinkorswim platform. I flip between TradeStation and Thinkorswim. I tend to prefer Thinkorswim a little bit better. It's a little faster for me and I can do some really cool tricks with it. So for call credit spread, targeting 160, 165 area, 160, 165, I can sell a spread at $1.02. I can get $1.02 credit, right? And that is for July 16. Some people do 0 DTE, 7 DTE, and so on and so forth. So remember that when this is just like any other trade or position that you get into, you have to give yourself time to work. But for vertical spreads, people tend to do a little bit shorter time. But I would say that, don't go too far out on vertical spreads. But and we'll see why we don't want to go out too far out on the vertical spreads, especially if you're selling the premium. As a matter of fact, I'm going to see. We've got some noise here from somebody.
I got it.
All right, good deal. Since we are selling, just go with today's date as an example. So because of the time, it's now 2:21. Market has got about 2 hours to close. This 160, 165 does not have much premium, but we're still going to use it for an example here. And right now you can get 0.04 cents. Don't go selling 0.04 anything spreads in the market. They're not worth it. The commission alone is more than this premium. If you're selling anything for less than 20 cents, you're just wasting money, because there are 4 legs in a vertical, 2 to get in, 2 to get out, right? So just those 4 legs at about $1.50 each is going to cost you on average $6. Well, with 4 cents, you're not going to get any money. You're going to owe TD Ameritrade some money. So don't go selling anything that has premium of less than 25 cents. Even 25 cents, you're just getting 5 cents premium, and that's not good. So just for example, for this one, if we decided we're going to sell the 160, 165, that's how you would do it. Let me do that one more time just to show you guys. I am on the call side. Remember, there's 2 sides. There's the calls side and there's the puts side, right? And I am clicking on the bid column. This is when you're selling and you're going to receive this amount that is displayed here as the premium, as opposed to this one when we're going to get to the ask side here in a second. But this is the side that you click on to sell premium on the underlying. So you would click, you would adjust your quantity here, go with 1. Then you would you can always negotiate your price. Say put in 0.50 for instance, and this would be a limit order, and it can be a day so that you can get filled the same day, and then confirm and send. And let's look at the profile on this one. Can you still see this screen?
Yes.
Awesome.
I see your big screen and then the order confirmation dialog.
Awesome. So let's look at this is what I wanted to show you guys, this order confirmation dialog. You notice that I'm selling the weekly. It gives me the information about the spread that I'm selling. It's a 160, 165 call at 50 cents. It's a limit order. Maximum profit I can get on this one is $50. And let's calculate how that happens. It's because I'm calculating the width of the spread, which is $450. Sorry, $500 minus, I said that backwards, right? I said that backwards. Your maximum profit is the premium received, right? It's the premium received. So if I sell these for 50 cents, it's the same as saying that I'm selling it for 50 cents times 100, which is $50. That's the maximum profit that you can receive on selling this call credit spread. The maximum loss that you can get, that you can achieve on this one, is the width of the spread times 100 less the amount of premium that you received, in which case that would be 500 minus $50, which gives me $450. That's the maximum loss, and this actually does confirm that maximum profit here is 50 and maximum loss is 450. So always read this confirmation dialog to let you know where, is this a good trade? Is this a good risk to reward? That kind of thing. In general, the risk to reward for verticals is very, very poor, right? It's very poor. So if you know a thing or two about risk and reward, is that the higher the risk, the likely for you to get into profit. The lower the risk, the likely that you will not get the profit, right? So that should already be something, part of the what you know about trading. When there's a lot of risk, then you get a lot of money, and when there's no risk whatsoever, the market is going to trick you in telling you that, yeah, you can get it, but really you're not. So low risk, low reward. Okay. Questions on that? Any questions on that? Okay, no questions on that. Let me switch to some interesting. I did say I was going to look at some other interesting symbols like SPX also. I know that there's a lot of interest in SPX, so I'll talk about it. I know somebody said shop, but let's look at SPX because it's live right now, and we can have some ideas. Currently, SPX is trading at 42.12. If I go to the chart, yep, that's where it is right now, 42.12.17. And we'll talk about Amazon here in a second. So let's see what kind of trade can we get into. Would we go with a call credit spread, or would we go with a put credit spread? And when you're talking about the credit spreads, here's the tip. You want to choose a point on the chart where price is, listen to this, not going to go. Right? Not going to go. That is the premise. You want to choose your strike prices where price is not going to go. And that's very difficult. We know the momentum is up, or we know the momentum is down, but we don't know how high it will go or how low it will go. So for instance, today is kind of a dodgy day, just like yesterday and the day before. Price seems to be going up. Will it continue going up, or will it, pull back a little bit? And then right now I'm looking at the day chart. What if I drill down to the 1 hour chart? I can see that we've kind of had, excuse me, we've kind of just had some sideways movement. This one actually fits the profile of, what's it called, a bull flag or something like that, when you have one long candle and then it's just up and down looking for a breakout. So on today's date, on today's chart, we are not sure. We don't know whether price is going to hit 42.30 or whether it's going to hit 41.90. You should have some indicators that let you know where price is going to be, right? What price is going to be. So on a day like today, I'd probably choose something above 42.30, 42.40, and below 4,200 once I chart this. Let's talk about Amazon. But before we do that, let's do a check here on. Let's do a check here to see for understanding who does not understand or who has questions on the credit spreads.
Okay, right now I do not see any hands raised, and I
Okay.
do not see any questions on this. Okay,
right.
we got a hand. Katrina, we're coming to you. Go ahead and unmute yourself.
Hey, everybody. Thanks for taking the time to explain this. So my question is, how much do you need in your account, or how much does this hold against your account while you're in this trade, since it's a credit spread? Is it just based off how much you could what your maximum loss is?
Okay, great question, and I totally forgot about that. So the amount of margin that you need, I'm going to call it margin. That's the right term for it. It doesn't mean that you're actually using margin, but that's the general term that the market uses. Is usually the width of the spread. So if you're doing a 5-point wide spread, then you need 5 points times 100, which is the multiplier, right? Makes it 500 for one contract. If you're going to do 10 contracts, you're going to need 5,000 contracts. Sorry, you're going to need 5,000. Is that right? It's 500 times 10. It's $5,000. You're going to need $5,000 to do 10 contracts. If you're going to do 5 contracts, you're going to need 2,500. That is most platforms that I know, at least in Thinkorswim. When you sell a credit spread, the amount required to be in your account at the time you do it is the width of the spread. So on 5 point, you need $500 per contract. On TradeStation, I hear they do the math a little differently. On TradeStation, it's the width of the spread plus the potential premium that you're receiving. They hold that ransom in your account, which to me does not make so much sense, but apparently that's the way it works with TradeStation. All right, good question there.
Okay, Yolene, we're coming to you. Please unmute yourself. And tell me how to say your name correctly, please. I know I butchered it.
You said it correctly. Thank you very much.
Okay.
Anyway, thank you very much to the two of you for your time. I appreciate it. I have a question on cash settlements. I hear about cash settlements when it comes to SPX as opposed to, like, for instance, equities. And these two things frighten me because when I try to do to practice on this sim, they tell me that I don't have buying power. So
Okay. All right. So that question is right in line. It falls in perfectly here with verticals because that actually happens at expiration, right? We were going to talk about what happens at expiration, but let me first talk about the difference between cash settlement and regular settlement, right? So cash settlement applies to indexes. So I'm talking about SPX, RUT, XSP, those kind of symbols are the ones where you're concerned about cash settlement. It means that there are no shares in the underlying security that you have to own. You cannot own you cannot own a share of the S&P 500, right? If you did, that'd be totally awesome. But yeah, you can't, right? Because the S&P 500, for instance, is a representation of 500 companies, 510, 505 companies, give or take, right? But it's the S&P 500. You can't own all of that. Whereas an equity like Apple, it has stock. You can own a share of stock. So when it is settled and say you're assigned to buy, you assigned one contract, the broker is saying that, you know what, your spread ended in the money, and so you have to buy or own what you said that you were going to buy. Remember, the contract says that there's two pieces of the contract, two legs. There's the short leg and the long leg. The short leg is the one where you could potentially be assigned. The long leg, you have the obligation, but not the, you have the right, but not the obligation. But on the short leg, somebody else has that obligation, has that right, but not the obligation, and they could exercise their right. So when you're assigned one contract, one option contract on Apple, it means that you have to buy or have enough money to buy 100 shares of Apple. Does that make sense? So the recommendation is that since everything has an expiration date, you want to be out of the trade before it expires. Right? That's number one. You want to be out of the trade before it expires. That is when you're doing straight calls and puts, as well as verticals. The other consideration is to try and have this position expire out of the money. So last week we talked about in the money, at the money, and out of the money. So you always want to be out of the money when times come, when the expiration date comes around.
thank you.
Okay, Brandon, we're coming to you. Please unmute yourself.
Okay, hey, thanks. And hey, Eddie, how you doing?
Yeah, good, Brandon.
Good, good. So I had a quick question. In trade stations specifically, I was trying to get into a vertical spread on SPX. I had under 2,000, so I didn't have enough so that the margin advantages actually take effect. But the way I calculated it, the max loss was still less than I had in my account. Do you know if TradeStation limits the ability to do vertical spreads if you don't have at least $2,000?
I believe you can do vertical spreads at a certain level. So let's first talk about the levels that you need to do spreads. You need at least level 3 to do spreads, right? Level 3 will allow you to do debit spreads. You still cannot do. Think about that for a second. You cannot do. And I'm checking it up here as we speak. Levels, option approval level. I'm going to bring up a link here that will help you guys. You can see my screen here, right? Can you see my
Yes.
option approval levels? Okay, so this is TradeStation. This is what they say. With level 2, you can buy calls, buy puts, write covered puts, and so on and so forth. With level 2 and above, you can do stock option spreads. You can do index option spreads, butterflies, condos, butterflies spreads, and condo spreads, all that good stuff. So level 3 is the one that I would say first and foremost that you need in order to do option spreads in TradeStation. Right, yeah. That's number 1. Then that is any kind of spreads. I believe that is any kind of spreads. Now, as far as how much money you need in your account to do that, if you have level 3, I don't know that you actually need $2,000. You might need the $2,000 maybe for margin. Yes. Well, now that we think about it, you do need at least $2,000 as we think through this. The reason you need at least $2,000 because that's the level at which margin at which you can get margin on almost any account. That is true on TradeStation, on Thinkorswim, on E-Trade. I'm not sure about Fidelity, but I think $2,000 minimum is the point at which they give you margin. And that's the point at which you also get level 3 if you request for it. So.
Right. Yeah, and I originally had 2,000. I took a loss like the day before, so it fell under 2,000. There was another, and that was on a spread. I was trying to get into another spread, so I didn't know if it was due to that funny calculation in terms of how much they say you should have. That maybe kind of took me out of the ability to do that, or if I truly needed at least $2,000 to even attempt any kind of vertical spread in TradeStation.
Both, actually.
Both. Okay.
Yeah, you fell under the 2,000. You lost your eligibility to do vertical spreads.
Gotcha. Okay.
Yep.
Cool. Appreciate it, man.
You're welcome.
And check the chat, Brandon. Tasia dropped some information about that also.
Awesome. Thanks. Cool. Let's talk about debit spreads. Anybody know a thing or two about debit spreads? Crickets. Nobody knows about debit spreads.
Hi, Eddie. It's Lee. I know something about it now.
What do you know about debit spreads?
I mean, well, just what I learned on Sunday.
Okay. All right. Okay. That's cool. Let's see.
That's the kind of spread I use where I lost that money.
Okay. All right. Well, debit spreads. Let's talk about debit spreads. So why would I use a debit spread, right? We discovered here that for credit spreads, you are getting paid to get into the trade, right? That's a good thing, and that you just need the width of the spread as your capital, if you will. So if you want to buy 10 of them, if you want to sell 10 spreads, then you just need, 500 times 10, which is $5,000. And you can sell 10 spreads. Well, let's go another way. Let's do a change of mind here. I want to trade Amazon, but Amazon is costing $3,232 right now. Okay. If I wanted to buy Amazon, it's $3,234, and that's for a single call. Let's see what direction it's going. Right now, it looks like, go to a daily here. I'm not going to draw this chart, but I'm just going to assume that this is on a downward trend. Shall we agree that this is on a downward trend over here? So I'd be buying a put if I was trying to do an Amazon trade. Whoever said Amazon, were you looking to buy a put or buy a call? What was your thesis?
No, I was just curious because I've been trying to well, when I saw that the momentum is up, so I would try to buy a call, and then it would tell me that I don't have the buying power for that.
Okay, all right. So momentum right now is downward, so you'd be buying a put because the price is falling and you're expecting to benefit as the price falls. So let's see what if I were to trade Amazon to buy a put, just one put at the current price. Since we're just thinking about buying a put, would go 60 days give or take. 49 is close enough; it's closer than 84. But if I were to buy a put on Amazon, just one, at the money, I would need approximately $9,945. Just one contract. And every time it fell by $1, then I would make approximately 49 cents or 50 cents, which is equivalent to about $50. Now remember this from last week's class where we talked about delta, right? Every time that the price of the underlying changes by $1, the delta is how much we have made or lost, right? So to buy one contract of Amazon, a put, at the money right now is about $102.50, which is equivalent to I would need about $10,250, just one contract. Now, is that a lot of money? Or is that a lot of money? Right?
Yes,
It's a lot of money. It's a lot of money. Correct answer is yes, right? So I am thinking that I cannot afford to buy just one contract on Amazon for $10,250. That's way too much. That's out of my budget. So you know what I'm going to do? I'm going to look for a coupon. Ever heard of coupons in the stock market?
No, but you had mentioned that.
Yeah.
So
we're going to look for a coupon in the stock market. All right. You with me so far? Right. So this is not a joke, but let's see. If we turn this into a debit vertical spread, right? We're going to see how we can afford to take advantage of, I call them coupons. This is an eddy term. So I'm going to change my spread from single to vertical. And now I am going to buy the 32.30, 32.35, and I'm going to buy it for about $5. Let's see how much I can get for it. I can get $2.15. Right? You got $2.15 is how much I am going to pay to get into this vertical spread. This is a debit, meaning that I am paying to get into the spread. You with me so far? This is a debit spread, not a credit spread. I am paying to get into it. And we're going to look at the profit and loss scenario on this one. first and foremost, let's understand that I am buying the 32.35 and I am selling a further out of the money one, which is the 32.30. This one that I am selling is my coupon, right? That's my coupon, right? I'm just updating the quantity here, and this is a put, by the way. So as the price of Amazon reduces, then my premium is going to increase, and that's why I said that we can buy this at a discount, and that's what I mean. So let's look at the profit and loss scenario. In a credit spread, we identified that the premium received was your maximum profit, right? Let's remember that. But in a debit spread, where you're paying to get into the trade, the premium is your maximum loss, right? That's your maximum loss. And that's because that's how much you're paying. You cannot lose more than you put into it, because you're paying. You're not getting paid. You're paying to get into it, right? Let's also think about the width of the spread. The width of this spread is $5. So it's 32.30, 32.35. So that's a 5-point wide spread, and we're going to remember $5. We paid $2.13. And what's the difference between $2.13? Well, actually, let's just lock it at $2.15 for easy math. So I'm going to do 5 minus 2.15, $2.85. The maximum value of this spread at any one time, the maximum value is $5, which is the width of the spread, right? It's the width of the spread. So now let's ask ourselves some questions. If I buy this spread at $2.15, what is the maximum I can sell it for? Somebody please type it in the chat. Okay, Kuwana thinks it's 285. Any other answers? The maximum value of the spread is $5, so I can sell it for maximum of 5, right? So 5 is the answer. So if I buy it for $2.15, nobody's going to buy it for more than what it's worth, right? $5. So the potential profit, the maximum profit that I can receive, is the width of the spread minus the premium that I paid. Is this starting to make sense? It's just the opposite of the credit spread, but we're saying this over and over again so that it can hopefully resonate here. But the width of the spread is $5, and that's its maximum value. And since we're paying to get into it, to get out of it, we have to sell it to the market. And the maximum that we can sell it for is $5, which is the value of the maximum value of the spread. But we don't normally wait to get to $5. We will usually exit before it reaches 5. So you can collect your profit at any time, right? Let's talk about assignment. If you buy this debit spread and it expires, then it means that it either has some value or it does not have some value, right? And the value here would be the difference between the strike prices and where you got in. So it does have some value if price enters your spread. Let me draw some pictures here. We are talking about buying a debit spread here at 32. What was that number here? 32.30, 32.35. Okay. Okay, 32.30 and 32.35. It's pretty small over here. Let's go ahead and increase that. All right, good deal. So if it still has value right now, if this price continues to fall and goes through my debit spread, my put debit spread, then I will have achieved maximum profit because the broker is now going to pay me $5 minus 2.15. They're going to pay me $285, right? If I let it expire. This is a good thing. That's one of the differences between a debit spread and a credit spread. In a credit spread, if price goes through your spread, you achieve maximum loss. If price in a debit spread, if price goes through your spread, you get maximum profit. I'm going to pause for questions because this is something new. A lot of people might not have heard about debit spreads.
Okay, we got one question. Sophia,
Okay.
we're coming to you. Please unmute yourself.
Hi, Eddie. Thank you for doing this. My question is with debit spread, does the strike, the distance between the strikes need to be 5, or can you spread it out so that you have more room as long as you're limiting your risk?
You can increase the value, you can increase the spread. For Amazon, I know people who actually do 25 to 30 wide spreads, right? That is quite common.
Okay.
In fact, for debit spreads, a lot of people do 10-point wide spreads so that you have $1,000 in between minus the premium that you receive, say $200, and you can bank the 800 if price goes through your spread.
Okay, so you could probably get like a 3-to-1 that way.
Yep.
Okay, thank you.
You're welcome.
Okay, Lee. Oh, were you going to say something, Eddie?
I was going to say that this is also one of the reasons why a lot of people will do debit spreads as opposed to credit spreads, because it's a directional play, meaning that you're still playing the momentum and direction of the market. You still have to be concerned about all of those factors. But here you're defining your maximum loss and maximum profit. So let's think about that for a second. My maximum profit here was $2.85, which is low considering the amount of money that I put in. How much did I put in? $2.15. Actually, that's almost a 1-to-1 ratio. Very low upfront costs. Versus if I needed to do a credit spread, I would have needed $500 in order to do a debit spread, to do a credit spread, right? So the low cost of entry is one huge advantage for debit spreads. Let's go to that question before you forget.
Okay, Lee, we're coming to you. Please unmute yourself.
Yeah, I did almost forget. So Eddie, so once it, like, if it goes all the way through your spread, you don't have to worry about assignment though, right? Because
no, because
okay.
your maximum profit, the people who bought on the other side from you or you sold on the other side, they're not going to exercise. They'd be losing money.
Can I ask one other question? So you're looking at this in the same way you would look at buying, I guess, a put or buying a call, if that's what you were going to do, right?
Yes.
So you're looking at the chart and you're just adding on a separate leg to sort of minimize risks and costs, I should say.
I called it a coupon. You're bringing down the cost of your trade.
Gotcha. Thank you.
You're welcome. Cool. Any other questions on that?
No other hands raised. Let me see. We have a request to please do another debit spread.
Another debit spread. Okay. So we did a put debit spread, meaning that we were bullish. No, we were bearish. We were bearish on that trade. We were expecting price to go down. Let's do another one where we're expecting price to go up, right? Price to go up. And this time, let's do it on SPX, right? SPX. So what's SPX doing right now? We want to buy a single call, expecting that price is going up, right? And we can do 0DT, 4DT, does not matter. But for this exercise, let's see what the calls are costing. And let's say at the money right now, calls are costing $5.80, right? And that will require me to have how much for one contract? $580, right? $580. So since I don't have $580, I want to turn this into a debit spread. So I'm going to go to vertical. And now, with price being at 42.14, I've brought my price down to $330. So if I click one time on that, this time I'm on the call side. I'm going to buy it for $315 or $320. Lock that in. Just going to go with one here, for example. Confirm and send. Let's look at the P&L. My maximum profit here is $180. You see that? And it's $180 based on the width of the spread, which is 5, minus the premium that I am paying, $320, which is also my maximum loss. So if this thing falls up or down, does not matter which way it goes, the maximum that I can lose is $320. The maximum that I can get is $180. So if I just bought this and forget it and expect that the price is going to go through both my strikes, and right now my strikes are at 42.10, 42.15. If it goes above 42.15, then I will get the maximum profit, which is $180. This is a cash settled index, by the way, cash settled instrument, which means that the broker will do it automatically for me. If this were an equity, you need to do that yourself, right? You need to do that yourself, either by going in and calling the broker no more than 90 minutes before, after the market closes. So by 5:30 p.m. Eastern time, you need to call the broker and let them know that you need to exercise your right to buy or something like that. Or you need to sell your vertical for $5 at that point, and you can get your $180. So that's the difference between doing verticals on equities and doing verticals on indexes. You can do it on both, on anything pretty much, but just know that how they're settled at the end of the expiration is different.
Okay, we got one hand raised, Eddie.
Okay.
Jay, we're coming to you. Please unmute yourself.
Thank you, Saya, and thank you, Eddie. So I just have a quick question about, if I were to do this on the SPX, and price went through, like it went the way that I want it to go, and then the broker automatically settles it. Is that still a day trade?
No. If the broker does it for you, if it happens automatically at the end of the day, that is not a day trade.
Okay,
But
so I need to just let it expire in the money.
yes, you want it to expire in the money in order for that not to be counted as a day trade. But if you sell it before, then yes, that does count as a day trade. In addition to that, there are commissions that you have to pay on the extra 4 legs that are required to close that trade.
Okay, that makes sense too. Yep. Thank you.
Same to a credit spread. When it expires worthless, out of the money for credit spreads, you don't lose a day trade, and you don't get charged for the commission to close it. It just happens automatically. It's automatically settled. That is for cash settled instruments. It's a little different from equities, the way equities are handled. Some brokers will charge you to do it for you, some will not. So as a matter of good practice, I never let my spreads expire. even though I have good intel that they are going to expire worthless, my trading plan says I always either buy back my credit spreads or I sell my debit spreads, right? Whether they're going to expire worthless or not, in the money, out of the money, my trading plan says get out. It's not worth the stress at expiration of what could potentially happen, because at very, very close to expiration or at the end of the day, prices seems to move just too wildly, and you may not even get a good feel if you're trying to get out of that position. So some guidelines on debit spreads: try and go at least 2 weeks out, no less than 2 weeks out. The further you get out, the better for you on debit spreads, right? On debit spreads, you're also not looking for decay, for theta to work against you. You're pretty much, you're almost immune with theta when you're talking about debit spreads, as opposed to credit spreads where you want theta to work for you. You want the price to decay because you sold high and you want to buy low, right? For debit spreads, you're always buying low and selling high. It's the opposite side. You're looking at 2 months? Yeah, that's good.
Okay, Louisa, we're coming to you. Please unmute yourself.
Hi, thanks for taking my question, Eddie and Saya. Looks like you're buying these at the money. So isn't that contrary to what Terry tells us to go far away from it?
I don't think she says go away from the money. I'm always in the money. Do you have a reason why you would want to go out of the money?
No, I don't know if it's out of the money, but it's far away from.
So remember, we're talking about debit spreads here. For credit spreads, you want to go as far away as possible, right? So if you're doing, if you want to sell premium, you're right. You want to be as far away as possible. But when you're doing debit spreads, then sometimes you even want to be in the money, or at least at the money.
Okay, that's fine. That makes sense. Thank you.
Right. So do this in sim and make sure that you simulate how the price moves on a debit spread as opposed to a credit spread. So just to clarify, for a credit spread where you're receiving premium, you want to be way out of the money. How far? It just depends. If you can get enough premium, 20, 30, actually 30, 40 points away, that would be the way to go, right? On either direction, whether it's a put credit spread or call credit spreads. For a debit spread where you're paying to get into it, you want to get closer to the money because you're improving your chances of ending in the money. Remember, for a call credit spread, you want to expire out of the money. And for debit spread, you want to expire in the money.
Okay, we have one more hand raised. Tarina, we're coming to you. Please unmute yourself.
Hey, Eddie, thanks for doing this. I have a question. I was trying to do the vertical for spread, the spread vertical, and what I couldn't find was how do you make sure that you're in the money if you're zone and you know it's going there, but it's not, you can't buy it in the zone. I mean, in the money. Like, I don't know how to. What I was trying to do is, it was at 222, and I was like, I know that it's going to go to 222 and then it's going to fall, right? But it was like, at that time, it wasn't in the money. Does that make sense?
Trying to get there with you. What symbol was that?
SQ.
SQ. All right. SQ. Okay, so SQ right now is trading at 222, and you were trying to do what again now?
Okay, so this was a week ago, and it wasn't at 222. You know what I'm saying? And I knew that once it got to 222, it was gonna fall again. But when I was there, it was like at like 216. So it wasn't where the little boxes are. If I, you know, I know y'all call it in the money and out of the money, but it wasn't there yet. You know what I mean? Yeah, see, it was way down here at 210, but I knew it was going to go up to 220 and then fall back down. So like it did yesterday. And I wanted to do it, but I every time that I went, I was like, well, it's not in the money. I wouldn't that y'all always say be in the money when you do this. So I was trying to figure out how would I have executed that trade?
So were you trying to do a vertical spread on these?
Yes.
Okay. And did you want to get paid or did you want to pay to get into it?
Well, I knew that it was going. Well, see, that's the thing. That's probably the part that I gotta work on because
Okay.
what I was trying. I knew it was gonna go down, but
All right. So your thesis was that it was going to go down once it hit 220. Is that what you said?
yep,
Okay. Well, so 220 is right about there. And what happened? Did it go down?
it did. Because
Okay.
if you look at the green candle before the red candle,
Yeah.
it went up and then it came right back down,
All right.
and then it closed down, and it closed down right where you know what I'm saying? Well, it looks like I would have missed out because it was 76 cents above, right?
Well, that's just where I drew that. So I'm thinking here that if you were going to do a call credit, when was this that you were thinking about that?
Last week,
Last week, and this would have been an expiration date of when?
2 weeks, 2 weeks away.
2 weeks away. All right. So this might be actually a very good example here. So 2 weeks away would have been or is 11 June, right?
Mm-hmm.
And we're thinking about the 220 strike.
Right.
Is where we think that
You see
we
how it's
don't.
not in the money because it doesn't have the little blue square on the put side,
Mm-hmm. Yep.
and that's what I was trying to do.
Okay. So let's talk through your thesis here again. So in 2 weeks, at approximately 11 June, in 2 weeks, is your theory or your thesis that price is going to remain above 220 or below 220?
Below 220. Because
You think
Square
it's
has
going
a
to be.
yeah.
Keep going.
Square has a way because like see how it's going up, but it's only gonna go up to this little red candle and it's gonna drop back down.
Which red candle?
Um,
This
I
one?
think that's like no, go over to like 510. You see 510?
Yep.
See the red one right there? Yeah.
Give me a price. Approximately there?
No, the other candle right next to it on the yes, that one right there. I knew it was gonna go there.
Okay.
It's gonna go there, and it's gonna drop back
Okay,
down.
let's talk about it. So the thesis here that she's talking about is that price will remain below 229, or let's call it $230, right? We'll just say $230 just so that we can have a good point of reference here, right? And we'll try and help you out. And the current price right now is $224. So her thesis is that within 2 weeks, or give or take, price may come close to 230, or it may even go past 230, but within that time, during that time, it is going to come back down below 230. It's going to stay below $230. So far, am I right on that?
Yes.
Okay, so what is the strategy that we can employ when we have a thesis that the price is going to remain below $230? The correct strategy to employ when we have that feeling or we have that information is that we want to sell a call credit spread, CCS, right? CCS is a bullish, sorry, it's a bearish strategy. A call credit spread. Why a call credit spread?
Yeah.
Let's think about it. A call credit spread means that my short leg is going to be above the 230 and that price will remain below the $230. Are we together so far?
Yes.
So if I were to do this, I would actually just find where can I get premium above $230. And that would make it a call credit spread. So let's go back to the option chain and see where that is. That was a long story just to do this, but I think it's important to just walk through that mental process, that math. So we're looking for premium on a call credit spread that is above $230. That will give us some premium, expiring by June 11. So I'm going to go back to my option chain and my short leg. So I'm looking on this side. This is the side that I look for premium for call credit spread at CCS. And I'm going to look above 230. So I see here that I can sell the 230, 232.5, or I can go a little safer and go the 232.5, 235. This is a 2.5 point spread, so the amount of margin that I need is only $250 per contract. That makes it a good deal. All right, so I am going to sell just one for this example. So I can, it looks like I can get 71 cents of premium by selling that 232, 235. Right? If I do a confirm and send, let's look and see what the profit and loss scenario looks like. My maximum profit on one contract is $72. My maximum loss is $178. And that is calculated by the spread of the width minus the premium that I am receiving. Does that make sense?
It does, but okay, but when you was on the, when you picked it, it wasn't in the purple.
Right.
It wasn't in the money, right? Does that matter?
Yes and no. The reason it is not in the purple, it's not in the money. Right now, it's out of the money.
Mm-hmm.
Yep, because I'm on the call credit side. I think you're thinking about this side. I'm not on the put side. I'm on the credit side.
No, it doesn't matter to me on either one of them. I just thought that you had to always be in the money when you did this.
Not necessarily. No.
Okay.
No.
Okay.
No.
That you cleared that up. That's what I thought.
Yeah, this is a call credit spread. So you want to be out of the money if possible.
Okay.
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 So that would be a good play if you thought that the price of Square is not going to go above $230 between now and June 11th. Right. And the way that you would make maximum profit is if at the expiration it is at if it is below $230, then you get to keep the full $72. Right.
Okay. Thank you, Eddie.
Right. I should also add that as you progress, as you get closer and closer to the price, the value of your spread will increase, which means it's going against you. But if the price continues to fall, then essentially what you're looking for is you're really looking for that premium to decay such that it goes down to zero. So you can sell it back. You can buy to close at 0 or 10 cents or something like that. Probably not at 0. Maybe 5, I believe, is the minimum, or 0.1 cent. Yeah, 1 cent is the minimum that you can buy to close. Did I see another hand up?
No hands up, no questions in the chat.
Awesome. Awesome. What else did we say we're going to talk about today? Just verticals, right?
Oh, we just got a hand. Louisa, we're coming to you. Go ahead and unmute yourself.
Hello again. I know you love to answer questions, Eddie, so I got them for you. My question now is, if I did this with my sim for the debit, the one you were talking about earlier, you buy the vertical, what did I do? I bought a vertical call debit, right? So I expect that the price is going to go down. And
Wait, you bought a debit spread?
yeah,
A This was a call debit spread or a put debit spread?
a put. I'm sorry. A
Okay.
put.
So
Because I expect the price to go down.
you bought a put debit spread, you're expecting the price of the underlying to go down.
Yes.
Okay, I'm with you so
And
far.
so
Okay.
I bought it at the money.
Okay.
And now what if it doesn't move anywhere? What if the price just goes sideways?
Okay. If price just goes sideways, then your premium is probably going to decay. Something is going to decay, right? You want price to move into your spread and through your spread. That is the best case scenario when you're doing a debit spread.
Okay, good. But if it doesn't, it's okay as long as it.
Well, if the premium does not move, it means that you might have to get out at a loss.
Yeah.
Yeah. It's like buying one call of Apple at $130 and it doesn't move. What's going to happen at that time?
Nothing.
Pretty much, yeah.
So we really want.
But with options, two things happen. Decay happens and expiration happens. So with the decay, it means that your premium could reduce even if price does not change, because there's theta that is eating at least one of both legs.
Okay.
Yep.
That makes sense. Thank you.
Right. And then with the expiration, it means that you could lose 100% of the premium that you put in, even if nothing else happens. Cool.
Okay.
So I think somebody wants us to do another debit spread, right?
Yeah, and we have one hand raised.
Okay.
Sophia, we're coming to you. Please unmute yourself.
Right. So I guess my question is, with a debit spread, is this something, again, if you're looking at the VIX, right, with credit spreads, you're better off selling them when the VIX is high, right? Because you're going to get more premium. With a debit spread, does it matter? Like, would you just use it to minimize your loss, or like, should you not? Like today, right now the VIX is at 16. So would this be a better day, or?
Yeah.
Or do you just not? Does it not matter?
It does matter. For volatility, you actually do want to get in during low volatility times, because the premium is going to be low, right? Let's think about that. Let's think through that. On a 5-point wide spread, the maximum value of that whole spread is $5, right? And when you're buying into it, you want to buy it as low as possible, meaning that if I can get into the spread for 25 cents, right, then my maximum profit here is the width of the spread minus 25. So I want, when is the price 25 cents versus when is it $4? Right? It's at 25 cents when there's no volatility, not a whole lot of action going on. But it is at $4 when there's high volatility, or if the VIX is high and that particular underlying is affected by volatility in that sense. So it is safe to say that volatility being low is very, very good for debit spreads to get in, and then you want to get out when volatility is high. And then for credit spreads, you want to get in when volatility is high. I think you've heard me say that when all the commotion has happened in the marketplace, everybody's screaming, that is the best time to get into a credit spread. You get a lot of premium. And then when all the noise cools down and people are like, what happened, is it still burning? No, there's no fire. They're like, meh, all right, so prices are back to normal. Now you can buy or sell back your spread. So what's true for credit spreads most of the time is the opposite is true for debit spreads. Low volatility, good for debit spreads. High volatility, good for credit spreads. Okay.
Thank you.
You're welcome. All right, let's do a debit spread here. Okay, so for who has a chart, who has something that's going up, let's try. Actually, let's try this one. I want to buy a debit spread on Square at $220, right? So this would be 87 cents. It's at 223, and I'm going to pick at the money here 220, 2.5, 225, right? And it looks like I can get these for $1.25. Let me talk about something before I hit that. Notice when you're doing debit spreads or credit spreads, sometimes this bid ask is very, very large, and that may affect the speed at which you're able to get into that trade. And this is again true for whether you're doing calls or puts. You always want that bid ask to be as low as possible. So because this one is between $1 and $1.55, it means that when I push the 155, that is why that 155 is not in here. It is somewhere in the middle based on what the market is offering. Okay, so let's go ahead and just buy one on this one for $1.28, expiring in June 21. Confirm and send. Our maximum profit is $122, which is the premium which is the difference between the width of the spread minus how much we're paying to get into it. Okay, send. And this may take a little bit of time to get in. I don't trade Square that often, but we're going to take a look. All right. So I think in Thinkorswim it does show. Yep, it does show when you have an order pending, just like in TradeStation. What's a base hit? A base hit is it's a bird in the hand, right? Take it while you have it. Take the profit when you can, not when you have to. Yeah, that's what you should do. Good deal. Well, today might be a short day then. Gail, what's up?
Go ahead and unmute yourself, Gail.
Hi, sorry, Eddie. Just talk through the thesis again for the credit and for the debit for me, please. Because you talk about the debit.
Say one more time.
I'm talk about your thesis. When you say you're talking about the put debit spread, but I'm not sure if you went through the call credit. The call, was it the call debit spread?
Yeah, we just did one.
Yeah, but I think I'm confused. When do you do the one versus the other? One is when you want to collect the premium, and one is when you want to pay. But are they not opposite sides in terms of bearish or bullish?
They are different strategies. So the one that we just did, remember we just bought a debit spread here for we did a call debit spread for Square, and our thesis here is that price is going to go up, right? When I'm on the debit spread, it kind of correlates with what you're doing. The call debits, it's bullish, you're expecting the underlying to go up. When you buy a put debit spread, you're expecting price to go down of the underlying. Whereas when you're doing the call credit spreads and the put credit spreads, a call credit spread is actually when you're expecting price will stay below or continue downward, so it's actually bearish. Whereas a put credit spread is bullish, meaning that you're expecting price is going to stay above your strike, your spread, and so it's a bullish strategy. So right now we just got into a spread which was bullish, meaning that we're expecting the price of Square to go up. And if we go to our monitor screen, and looks like we got filled at $1.20, and so far we're making $5 on these. Why are we making $5? It's because the price of our debit spread has increased, right? So if I were to set up a closing order on this one, notice that it is now at $1.25, and so I can easily go to maybe $2.25 would be, just a hypothetical target to close these, confirm and send. That's my closing order. Let me give you guys another tip. This one is golden. When it comes to spreads or calls, if you know what your exit point is, go ahead and put it in immediately after you put in your opening order. The reason for that is because orders are filled on a first come, first served basis. Don't wait for price to hit your target area before you put in your order, because then you're going to be standing at the back of the line, right? So just a tip is, and that's why your trading plan should be very, very, as precise as possible. Just go in and put in your buyback order. For me, I found that works beautifully, and sometimes, many times I actually get filled in this week right here. Sometimes even before this week has painted, I get a feel, and I didn't even see it. My eye did not see that. But as long as it's in the system, it's a fast in, fast out, and you're competing with you're competing with a million other people. So right now we are in a call debit spread. We paid $1.20 to get into the spread. It is how many point wide spread is it? Oh, let's think about that. 225. 225 minus 222.5. Oh, the maximum on this spread is $2.50. So my math here is wrong. The maximum price I can get is $2.50. So if I just add $1 to 120, then realistically I should be shooting for about 220. Is that right? 220. Yes. Let's do a cancel replace. Cancel replace. And that would be $2.20. All right. Does everybody understand why I did that? The reason I did that is because this is not exactly a 5-point wide spread. It's a $2.50 wide spread. So the maximum value on this spread was $2.50. We got in at $1.20, and we're looking for $1, so we put in a buy sell order for $2.20, which is just slightly below its maximum value. Okay. Hope that that example was good.
Someone just asked you to repeat that.
About why I changed from 225 to why I changed the price.
I think.
Okay.
Yes.
So,
yeah.
Got it. I forgot that this was a $2.50 wide strike. Right. There's the difference between my strikes is 220, 250, and 225. The difference between those is $2.50. So the maximum value of this debit spread is $2.50, which means that if I put in a buyback order for anything more than that, I will never get filled. Nobody's going to buy it for more than it's worth. So my target price is $2.50 less how much I paid for it, and I paid $1.20. So somewhere in between there would be how much I would receive, right? So I just added $1 to my premium, I paid $1.20, and I'm saying I am going to try and sell it for $2.20. That's why I did a cancel replace on that order.
Okay, we got a hand raised from Louisa. Please unmute yourself.
Thank you. So Eddie, how do you monitor this as you're watching it? Where do you watch it?
So right now I just did a straight, no risk management kind of deal. I don't normally do that. Usually I will go in with risk management. And the way to do that is to put in a bracket order, right? Not all platforms have bracket orders, but I like Thinkorswim because I can do a bracket order on verticals. And let's do this same trade one more time, but this time with a bracket order, right? I'm going to show you how to do that. So the way you would do that is going to your trade, and we picked the 222. Let me write this down so I remember. 222.5 and the 225, and that was a call debit spread. I believe it is this one right here. So to do that, I would simply click one time on that to bring up the order. Notice it's still at $1.20. Let me get rid of some of these. The next thing I would do is change from single order to fast triggers OCO. You all know what OCO is, right? So that's order cancels order. I'm going to change that to fast triggers OCO. Next thing I'm going to do is create the opposite order. So that is my take profit order. That's what I call it. But I'm also going to create a duplicate order on that, and that is going to be my risk management order. So let's change this a little bit. I am saying here that I'm buying this vertical for $1.20. If the price of this vertical reduces, then I'm losing money. You with me so far? How much am I willing to lose? Right? And let's go 50% and say that if the price of this vertical goes down to say 60 cents, right? 0.60, then that should take me out. No, I did that backwards. This is my take profit. I scratch what I just said the last 30 seconds. I want to get $2.20 out of this trade, right? And that's simply $1 plus $1.20. $1.20 is where we're getting in, and I want to get out when it reaches $2.20. And then my risk management leg is the third one, and I'm saying here that if this spread were to lose value and it goes down to 0.6, then I should come out, and this should be turned into a stop, right? So now I have 3 orders set up. Let's go ahead and lock this at 120. Lock that in. Confirm and send. Let's read what this tells us. So this is an OCO order. Let's change one more thing. For these examples, I want to just go with 1. And by the way, you can change your order defaults, and I'll show you how to do that here in a second. Okay. All right. So we're buying one vertical spread for square at $1.20. This is a debit spread, meaning we're paying to get into it. That's why it says buy. And then our order number 2 is our take profit order, which is going to be triggered by the number 1 order. And it says that we are going to sell at $2.20 once it reaches that value. And then our third order is our risk management, which is our stop loss order. And if the value of the spread goes down to 60 cents, then we should exit the trade. And all of this is going to be done automatically. So we review, we'll click send. All right. So that is how I quote unquote monitor my spreads. I usually put them in as OCO orders. And I can go into monitor screen in Thinkorswim and notice that there's a lock on this one, right? And this is a condition order, and that's why you can see this link. If you're looking at the left side of my screen, you notice that these two are conditional orders, right? If I wanted to modify this, order, right now I can see that the mark is $1.15. It's reducing, so maybe the price of Square is coming back down. Yep, that's true. That's why it's reducing. Okay. Oh, it just got filled. Remember, we're live, so we just got filled at $1. How much did we get filled at? We got filled at $1.20, right? So once we get filled at that price, then these two orders remain in the system. Once it reaches $2.20, system is going to automatically sell it for me. If by any chance that price falls and it falls all the way to 60 cents, then it is going to also take me out at 60 cents. So for those who have to put in an order and go to work, then this is a good way to, I don't want to say set it and forget it, but yeah, set it and forget it.
Okay, Tarina, we're coming to you. Please unmute yourself.
So Eddie, on this one, I just want to be clear because I'm really trying to learn this vertical thing. With what you just did, I wouldn't have to wait all the way for the 2 weeks to gain profit or lose. I could just get out.
Yeah, system's going to take you out today or tomorrow or whenever.
Okay, cool. Thank you. Appreciate that question.
Yep.
Okay, and we got two questions in the chat. One is a $3 bid ask spread too high? And the other one would like for you to repeat what you said about volatility.
Volatility. Yeah,
Yeah.
$3 is on the higher side of the bid ask spread. You want that to be a little tighter. The recommended spread is about $1 or less for the bid ask spread. You want it to be, and she's referring to, when you're looking at the option chain, the difference between these numbers, the bid and the ask, you want it to be as tight as possible, right? Volatility. When you're buying vertical spreads, when you're buying debit vertical spreads, meaning you're paying to get into it, you want to buy it during times of low volatility so that the prices are low. And then the best time to exit is when there is high volatility. Now, since you can't time the exit very well, that's why it's a good idea to set in your sell order immediately after you put in your buy order, or just do the OCO like we did a second ago. Can you put a stop loss on calls? Yes, we just did. All right, good deal. All right. It is about 3:38. Let's have a couple more questions before we call it a day.
Okay, I'm checking. No raised hands yet. I haven't seen anything new in the chat.
All right, so I can recap over here before we close. So today we talked about vertical spreads. We identified that vertical spreads are multi-legged strategies where these are directional plays. You're expecting price to move in a certain direction, or you're expecting price to stay within a certain range. For call credit spreads and put credit spreads, we are selling those far enough away that we do not want price to come close to us, basically our short leg, right? That is when you're selling for premium. When you're paying to get into the spread, you can be as close as you need to get close to the money. And the idea here is that the price action will go into your spreads, through your spreads, if possible, and that is when you achieve maximum profit. We identify that for call credit spreads, the amount of margin required is the width of the spread in general. And for debit spreads, the amount of margin required is simply the premium. So with a $1,000 account, you can actually do some debit. Let me think about that carefully. Can you do debit spreads? No, you still need $2,000 minimum. So most brokers will require that you have at least $2,000 in the account and that it be a margin account. And the reason they require margin account is in case you get exercised or assigned on one of the legs, usually the short leg. We also saw that once you get into the spread, you can send your buyback order or your sell order immediately. That is the recommended way to do it. So you should always have your defined entry and exit points as part of your trading plan. So if you're buying a spread for $1 and your target is for it to get to $1.50, then set your sell order for 1.5 or $1.50. Always do that. For credit spreads, you want to put your buyback order. So if you receive $1 of premium, then I would recommend, very highly recommend, that you put your buyback order for about 20 cents, right? If it's an equity, then put in your buyback order for about 1 cent or 5 cents, as the case may be. Don't let it go to expiration. The reason we want to avoid expiration is because of what happens there. Remember that price can be in your favor at 4 o'clock at the market close, but 30 minutes into or after the market closes, some instruments are still trading and potentially you could now get into the money or out of the money, as the case may be, whether you have a debit spread or a credit spread, and all of a sudden somebody's exercising. So you want to be out, completely out of your spread before the market closes. In fact, if possible, 2 weeks before that. Unless you're trading 0 DTE, you want to be out at least 2 weeks out. Okay. Let's see what else we. So we also saw that debit spreads, which is probably new for a lot of people. It's a way for trading some of these higher priced stocks like Amazon. Amazon costs 3,000 plus, and you don't necessarily have the amount of premium required to even buy just one contract. So you can use a debit spread, and in a way you're using the short leg as the coupon, right? Because you're going long, but you need a coupon, so you sell some premium. That is not insurance, right? That is not insurance. That's just a coupon when you're doing debit spreads. It's reducing the cost of that position. So we can see how now we can buy 10 spreads on Amazon for very cheap, right? Whereas for credit spreads, the long position is usually your insurance position. You're basically protecting yourself from the upside or the downside, as the case may be, whether it's a put credit or call credit. You're just ensuring such that your maximum loss is capped to the width of the spread less the premium that you received. All right, good deal, good deal. How are we doing, Sire?
We're doing good. I think you just answered Charlene. She had wanted to make sure she understood that we want credit spreads away from current price and debit spreads close to. So I think you just said that.
Yep, that is correct. And one more thing, for debit spreads, when you put in your your sell order, you want to do GTC, always GTC, because your spread could be filled same day or next day or any time before expiration. So always remember to use GTC as your time frame, right? GTC as your time frame. Yep, that's a good deal canceled. All right, let's see how we're doing right now. We are up $5. This is looks like this is a slow moving stock, I believe. Yep, we're up a whole $10. It's almost enough for 2 cups of coffee. All right. Can you be assigned in Amazon? Oh yeah, yeah. But most likely the broker will take you out before they assign you. And that's what happens with these large value, high valued stocks. The brokers pay very, very careful attention to your ability to sustain a position. So if the broker thinks for any reason that your position might become one where you get exercised on the short leg and you don't have enough money in your account to cover that, then they will, most of the time, they will ask you to either sell your position or they just close it out for you and tell you, look, we didn't feel safe, we didn't feel nice, we closed the position for you. Many times you almost never have a choice. They just do it. Good deal. Well, thanks again. This has been very exciting. If you have questions, by all means, hit me up on Telegram. A lot of you are finding me on Telegram. Just ask the questions in the Options 101 group. I do go in there every once in a while these days since people seem to be hanging out there quite a bit. So, all right. Hey, Saya, I think we are done for the day.
Okay.
Stop sharing these. And I am going to make this recording available and post it on YouTube. Thanks, everyone.